Welcome all to Corporate Issuers Learning Module 1. We'll start with a module really that's mostly discussion, just laying down the foundations and the basics of what a corporate issuer is. You can see the title here, Organizational Forms, Corporate Issuer Features and Ownership. Let's get into it. First, LOS of only 3 asks us to compare the organizational forms of businesses. So we'll do just that. And we'll start off with the simplest, a sole trader, sometimes known as a proprietorship. Features of a sole trader: no separate legal identity. So the owner is the business is the owner. It is owner operated. So the owner is the manager, and the owner has unlimited liability. Profits are taxed as personal income. It's known as a pass-through business. There is no separate entity. There's no separate corporate tax. You as an individual own, are the business, run the business, get taxed, and provide the finance, which obviously is limited to your access to capital. A general partnership is really a sole trader with more than one person. Doesn't have to be just 2, can be more than 2. But again, look at this. No separate legal entity. Owner operated, this time it's partners rather than an individual. Unlimited liability. Profits taxed on a pass-through basis. No corporate tax, no separate tax to calculate. And it is limited in terms of its growth because it's financed by the partner's access to capital. So think of a sole trader coming together with another sole trader, you've got a partnership. Get slightly more involved with a limited partnership. Here with a limited partnership, we'll have 2 different types of partners. We'll have the general partner and several limited partners. Once again, a limited partnership is no separate legal entity. Nothing else exists other than the partners, but it is operated by the general partner. So this is our first glance at a business setup where you have some of the owners, here the limited partners, not being directly involved day to day in running the business. It is operated instead by the GP, the general partner. That general partner still has unlimited liability, just like a sole trader, just like the general partnership. However, it's our first glance at limited liability. The limited partners have limited liability. Profits, however, are still taxed as personal income, so it is still a pass-through business. And finance still comes from the partner's access to capital. So for all 3 of these, the owners are being taxed on a pass-through basis, and the growth of the business is going to be dependent on the sole trader or the partners finding capital. Let's move on to the more complex situation of a company. Now, terminology is important here. First one we're looking at, I have called a limited liability company. If you're in the US, you may be familiar with an LLC, a limited liability company. Ignore this for the moment. We'll have this little chat in a moment. The limited liability company, well, it is different than everything else we looked at on the previous screen because a limited liability company is a separate legal entity. Now you have a separate thing. The board and management of that company run it. The owners own it, but they have limited liability and they are not involved on a day-to-day basis. So our first proper glance, we saw it a little bit with limited and general partners, but now our first proper glance at a completely distinct entity, which your partnership was not, run by a board and management, but owned by shareholders. We call the owners shareholders. They all own shares in the business. Shares are divided down into small units, so the owners don't have to all own an equal amount of the LLC. One similarity though, in an LLC, profits are still taxed as personal income. So this is still a pass-through business if it's an LLC. Big advantage, unbounded access to capital, unlimited, therefore, business potential. because you are not restricted here to raising capital through your owners. Yes, the owners may have put some share capital in, but the business itself as a legal entity can go and raise capital. In terms of how many owners you have in an LLC, there may be, depending on the jurisdiction, legal limits on the total number. And if you want more owners in or owners want to get out, there may be a vote required amongst the other owners to okay that transfer or veto it, as the case may be. Now, I mentioned this little bit of chat over here. There is a little bit of inconsistency in the terminology within the module, which they're aware of and they point out later on, and we'll point out as well. But just be aware, they start off here by talking about limited companies and say limited companies can either be private or they can be public. We're about to talk public down here. Up here, they do refer to this LLC as private. So the LLC falls under that heading there, a private limited company. But don't confuse this LLC, this private limited company, with a public company that is privately owned. Confusing, right? So that's why rather than write here, private limited company, I've written LLC. That is, I know, very US centric. It's the US example of a private limited company. But I think it was worth doing that just to keep it clean in our head. Later on, we'll look at public companies and talk about how they could be either privately or publicly owned, i.e. listed. Now, let's talk about public limited companies. Remember, if we're looking at this diagram, we're talking about either of these. If you are a public limited company, a corporation, once again, you're a separate legal entity. Once again, board and management operate, owners own. And in both situations, whether it's private or public, those owners, those shareholders have limited liability. That liability is limited to the equity they have put in. They're not responsible for anything else. We'll talk about that later on a bit more. Big difference though. With a public limited company, profits are taxed at the corporate level. So this separate legal entity will be taxed at the corporate tax rate. And interestingly and disappointingly, if you're an owner, dividends paid out will then also be taxed as personal income. So we'll talk about that as an issue shortly as well. And there are no restrictions on ownership or transfer as there was when we looked at the very restrictive limited liability company. So we have our basic setup, our basic methods of doing business. We're now going to focus for the rest of this module and the rest of this entire topic, for it is after all corporate issuers, on corporate issuers. So LOS here asks us to describe the key features of those corporate issuers. So here we go. Why are they called issuers? We introduced the idea of a corporation. Well, definition here is a corporation that raises capital in the financial markets is known as a corporate issuer. So we have hence corporate issuers. Bit more detail on them. We talked about these features already, but let's see what they mean. Separate legal entity, we said. It's a separate thing that gets taxed, but you have to form this separate legal entity through the filing of articles of incorporation with some regulatory authority. Obviously depends on the jurisdiction you're in. And worth pointing out, this is a global exam. So they're not going to focus on any one set of rules and regulations and how you incorporate. We're not doing a corporate law exam. It can engage in similar activities to individuals. It's a separate legal entity. It can do what individuals do. I mean, it's not sentient, but the entity itself can contract with people. It can hire employees and so on. It can be sued. It can be the subject of litigation. It is also subject to regulation. Jurisdictions where it is incorporated, where it does business, or where it finances itself will all regulate that entity. What about the owner-manager separation? Shareholders, as we said, own the business, but don't run it day to day. Instead, those shareholders will appoint a board of directors who in turn will appoint executive management, who in turn will take the investing, financing, and operating decisions on behalf of the shareholders in this separate legal entity. It is the responsibility of directors and management to act in the best interests of shareholders and, indirectly, all stakeholders. We will talk stakeholders versus shareholders in a later module. But keep that in your mind. This should be the phrase that gets directors out of bed in the morning. If they don't, and if that doesn't happen, then shareholders have votes attached to their shares. Could be that they get 1 vote per share. There could be different voting weightings, different weightings to each share, but they'll have votes to replace the board. What's the advantage of this owner-manager separation? It allows the corporation to obtain financing from a much wider range of sources. As we said, if you're not restricted to just your partners or the sole trader and their access to finance, if you can throw it up to the wider world, to the public, then your growth is, or rather your growth potential is limitless. So we've talked about how this corporation, this public limited company is set up, who owns it, who runs it. What about the risk that we're taking on and the returns? Well, they are shared equally between shareholders, the owners. I say equally in proportion to the shares that you own. And as we said, all have limited liability. That liability is limited to the amount invested in the company. You put equity in, whatever you pay to buy those shares, that is it. Your minimum share value is 0. They can't come after you for any more. Unless you behaved particularly nefariously, in which case they could. But, that again is a corporate law issue. You're not responsible for debt. If this company ends up with negative equity, if you end up with its liabilities being worth more than its assets and you can't pay that debt, it is not on the shareholders. Sources of finance, we said you have access to a much wider range. Well, corporations will raise finance via equity, the sale of shares to investors, or by reinvesting existing profits. They raise equity, they use that to generate profits. If they reinvest it in the business, that again is part of equity. Or they turn to the debt markets. Loans, bonds, leases, interestingly here, in this module is listed out as a form of debt. So just be careful about that when you get to financial statement analysis if you haven't been there yet. And talk about the definition of debt and ratio analysis, slightly different. How do you pay back those providers of finance? Equity holders get dividends, not guaranteed, no obligation to pay dividends. Debt holders get interest and their return of principal. They are obligations. They are fixed charges. Hence, for the issuer, for the corporate issuer, debt is riskier because you have to make those payments. From the investor's point of view, it's the opposite. Because you have a fixed obligation, then you have less risk. You'll demand a lower return. Equity, more expensive. How do you raise this equity or debt? Can be in a private contractual agreement between two parties, or it may be a standardized instrument, tradable between investors on an exchange that is a security. And again, we'll get into that in a little bit more detail in later modules. So what does this separate legal entity own? What does it owe and what returns does it make? How can we measure it? Well, 2 terms here. The financial side of it, so we can talk the financial balance sheet and the financial income statement, and the economic side of it, the economic balance sheet and economic income statement. This term, particularly this one, you've seen before in, appropriately enough, economics. When we talk about economic profit, we're talking about, have you generated enough to satisfy your providers of capital? Well, in this module, we extend that into the balance sheet as well and say, okay, we've got a financial balance sheet. If you've studied FSA, you're all over that. assets less liabilities gives you equity. If assets are greater than liabilities, you've got positive equity. But the economic balance sheet goes further. It adds in other intangible and hard to quantify assets and liabilities, which are also of value to the entity. For example, the human capital you have, what you've invested in human capital in your employees, the relationships you have with your customers, with your community, the internal and external governance you have going on. They're all valuable to the entity. They'll be included in your overall economic balance sheet. In the income statement, well, financial income statement comes down to net income. Your net income after all of your fixed obligations have been met, your accounting profit. But your economic income statement measures that economic profit we talked about in economics. That is the return in excess of the owner's required return on equity. So be careful with these terms. We can calculate return on equity. That is no more, no less than an accounting ratio, net income over equity. And again, if you've been through financial reporting, you'll be screaming that this should be average equity. We're not getting into calcs now, so it doesn't matter. But it's just net income. What did you generate given the equity you used? Economic profit. Compare the required return on equity. This is the key word that makes it different. What our owners require to the return on equity you delivered. And remember, in a competitive market, in the long run, it is entirely possible and expected that in equilibrium, this will be zero. To maintain positive economic profits, you have to have some sort of competitive advantage, which you can sustain. Because if you are making excess profits, it should attract other entrants to the industry and they should compete it away. And now a quick note on tax and a couple of numbers in the middle of this long descriptive module. Think about that taxation. We said earlier on, with a corporation, that separate legal entity is going to suffer tax at that corporate level. But as an owner, when you get the dividends, you get taxed on the dividends as well. So as an owner, you may well suffer double taxation, the corporate tax on profits and a personal tax on dividends. Here's an example just to illustrate it. Imagine you have pre-tax income of 838. The corporate tax rate you've suffered is 31.5%. That means the legal entity, the corporation, gets taxed 264. You've got 574 left. Now, assuming all of that gets paid out as dividends, comes back to shareholders. Let's say the personal tax rate is 30%. Out of that 574 personal dividend, you're going to pay personal tax of 172.2 and end up with 401.8. So look what happens. At a pre-tax income of 838, you're left with only 401.8. You've paid tax of 264 at the corporate level and 172.2 at a personal level. Out of 838, that is an effective tax rate of 52.05%. That is pretty eye-watering. And it's, there is no calculate LOS here, but it's just nice to see it. You can calculate that pretty quickly if you know the corporate rate and the personal rate. 1 minus that corporate rate multiplied by 1 minus that personal rate gives you 0.4795, telling you you will end up with 47.95% of the 838 you started with. 1 minus that tells you you've suffered tax at 52.05%. Now, there is some good news. In some jurisdictions, you do get relief. Some jurisdictions will give personal tax credits on dividend income, and some will change the corporate tax rate. So say out of this 838, well, whatever gets paid out at a div gets a lower tax rate, maybe even zero. So there may be relief. Final LOS, and probably where the most interesting information is, compare publicly and privately owned corporate issuers. Now, this is where I said we've got to be careful with the terminology. Corporate issuers here, we are talking about public limited companies from earlier, separate legal entities that are taxed. Those public limited companies may be privately owned or they may be publicly traded. So let's compare and contrast. Public, first of all, and just to be clear, when we say public, we mean listed here. Shares are listed on a stock exchange, which is great news because it means the company's shares are liquid. The exchange provides a secondary market for shares. Individuals can trade shares between themselves. Be aware that secondary market doesn't raise any more finance directly for the company because the share just moves between shareholders. The percentage of shares that are actively traded is known as the free float. For lots of big blue chip companies, a big percentage of the shares are tied up, either in just historic institutions that never let them go or founders or founding families. For example, I've given you here an example of L'Oreal because you're worth it. They're family owned 33%. Nestle owns 23%. That leaves only 44% of their shares to actually trade on the market. That is known as the free float. Another benefit, price transparency. If it is traded, you can look at the market and say, there is its share price. So be clear, that's the share price, price per share. We know the number of shares that are trading, or I should say, having just pointed out that some don't trade, the number of shares in issue times the share price, that is the market capitalization, the value of equity. Now, it's also worth pointing out that market capitalization is the value of equity. You will see throughout these models another term, which is enterprise value. So just be careful. Enterprise value is the value of equity and the value of debt. So both sources of capital less any cash you've got available to pay down that debt. So that's not what we're getting to here. What we're calculating is just the value of equity. So all good things. The downside, if you are listed, you have extensive disclosure and reporting requirements. On the one hand, with the local regulator, you'll have to register and they will mandate a whole host of disclosures. If you've been through financial statement analysis, you've seen a list of the kind of documents, for example, in the US that are required by the SEC. Typically in all jurisdictions, you'll need an annual report, 10K in the US. You'll need a quarterly. And for any big share transactions, insider transactions, material events, you'll need to register and file a report as well. To be listed, you'll also need to meet listing requirements, have a certain history, a certain track record, a certain level of corporate governance, and so on. If you register, you have the necessary disclosures, you meet the listing requirements, then your shares can trade on the stock exchange. As opposed to unlisted companies, private, meaning just unlisted companies. We're still a corporation, but unlisted. Downside, there's no ready market for the shares. Sale requires a buyer, and potentially in some situations, we said earlier on that, okay, now we're a corporation, we can transfer ownership, but there may be restrictions if it is a private company, depending on how the company is set up. And no price transparency. You can't just look and say, there's the share price trading, because it doesn't. If you wanted to value a private company, you would therefore need to come up with a model. And in fact, that's what we'll do. At level 2, we have an entire reading. How do we value private companies? Why are we interested in that? Whole section of the market, private equity, venture capital, and so on. The good news, fewer disclosure and reporting requirements. So this is really the downside of being publicly listed, having your shares trade, massive disclosures. If you're private, you can keep things private. And the downside of this isn't just pure admin. It's not just, oh, now I have to employ somebody to put all this together. You are giving out a lot of information to your competitors. You know, as a private company down here, your competitors might be saying, how do they manage to sell their product for that price? How do they do it? Well, now you have to start putting so much disclosure out there and so many reports. They can look into the detail of your income statement and they can see it. They can see your gross margin, your operating margin, your net margin, and start saying, that's how they do it. Their raw materials are cheaper than ours. How are they sourcing those? And so on. So you may not quite be ready if you're a private company to give that information out. Next up, how are shares issued? Well, let's start with a private company. A typical life cycle, if you like, of a company is to start off private and then go public. Private companies issue shares via private placements. They are not publicly traded, so they can't trade on an exchange. Their capital must be raised from, in again, most jurisdictions, accredited or sophisticated investors. Why? More risk. You're locked in for a longer time period. You can't easily trade these shares. They have low liquidity. Often these companies are in the early stage of their life cycle. They have higher risk. So the regulators will judge whether investors are willing and able to take on those risks. Now, when you make the private placement or offer the private placement, there will be a private placement memorandum. This will outline the risks and the terms of the deal. Now, if that is successful and you raise enough cash to grow large enough, you may then go public. And you'll go public via, most commonly, an IPO. And just bear in mind that the cash raised in your private placement is going to be a lot less than the cash raised in your IPO. You raise capital from the public as the first shares that hit the exchange. And it has to be said, I say it's the first shares. You'll issue shares to the exchange. It may also include some existing shares. So some private companies have existing shares that when they IPO, they will include in the IPO and sell on to the public. Or less commonly via a direct listing, so there are no new shares. Bear in mind, if there is no new shares, you're not raising capital. So the vast majority will go to the markets to raise capital via an IPO. Or a SPAC, special purpose acquisition companies. All the rage for a hot minute there. Calm down a little bit now. A SPAC is a shell company. So it sits there with no operations, with no business, with no nothing, but raises capital via an IPO. So the shell company goes through the IPO process. It's a lot easier for a shell company to go through the IPO process because there's very little due diligence to do. There's nothing there. But if you have willing investors and the investors trust the management of the SPAC, then they will put their money in to nothing with the trust and the faith that the SPAC will then make a successful acquisition. And the SPAC will tell you in its prospectus, in its IPO, what they intend to invest in, what their business line is going to be. So it's going to be space exploration, for example, was huge for a while. So you'll know the kind of company you're going to get, and there will be terms in there. If they don't make an acquisition within this amount of time, we get our cash back. So the shell sits there as a ready-made public company, and the private company just jumps in, or quite simply, as a private company, you could be acquired. Once you've gone public, had your big initial offering, you may then have subsequent secondary offerings, secondaries, where you raise even more capital from the public. We did our IPO, we're having another round of share issue. Just be careful here. Make sure you can distinguish between a secondary offering where we raise capital from the public and the secondary market. The secondary market is where shares are traded between market participants. That does not raise any new capital for the company. What about going in the opposite direction? Private can go public. What about public going back to private? Or quite simply, you would need somebody to buy all the shares, literally all of them. To do that, you're going to obviously take control. You're going to have to pay a premium to get every single share, usually financed by a lot of debt, but you buy all of the shares back and delist from the exchange. Why? Typically done when whoever is acquiring believes that the company is undervalued, either because the market generally is just undervaluing it, or there are changes that can be made to extract value from the business. So a restructuring, change the management, sell assets, and so on. What market conditions lead to public companies going private or private companies going public? A couple of examples given in the module. Emerging economies tend to have a growing number of public companies. Well, what else can we say about emerging economies? They tend to have high growth, are trying to open up their market structures and attract capital. So if you want to reverse that, you could say, a little bit of danger here between, causation, correlation, but you could say high growth, opening up markets, attracting inflows may well lead to a greater number of public companies, as opposed to developed, which tend to have a declining number. What's going on? Mergers and acquisitions. I think that's too interesting, really. But a growing number of private capital sources, private equity funds, venture capital, etc. Or maybe just a very basic desire to preserve ownership and control, not to separate them out into the markets and say, now I'm at the mercy of the public markets and analysts and quarterly earnings reports and so on. I want to keep it within the family, within the founders, and really focus long term. And that's often a comment up here. I'm going to take it private because the markets are undervaluing me by having a short-term focus. Down here, I can keep it in the family and have a longer-term focus and hence have a better performance. Evidence that that's true, that you do, in fact, get a better return by having a long-term focus is, to quote the module, thin at best. And finally, just a little chat about the different types of shareholders you may see for a corporation. Could include individual investors, obviously, big institutional investors, other corporations, we'll talk groups when we get to level 2, non-profits, or governments. And the module just focuses here for a moment on governments and says, you may have entities that are government owned, legally separate corporations, but the government maintains ownership. It may be required under their own mandate, may just be to be more transparent to taxpayers who effectively are the owners. A good example, the United States Postal Service, USPS, in the US. It's common for things like that, the provision of public goods. May also be used to profit from major domestic industries. The government may want a piece of the profits that are being made. Banks often established as government-owned entities in emerging economies, then transferred to a private or to the private sector, I should say, via IPO. Or technology may drive government-owned entities to switch to private ownership. For example, telecoms. Obviously, advancement in technology made telecoms an extremely profitable sector, and many governments figured private sector will do a better job at making profits out of this, so let's sell off licenses for them to provide it. And that's it. Not a big module. It introduces the key concepts of a corporate issue or what they are, the advantages, disadvantages, how they are owned, and how they are run.